So it's really hard to save and protect our money these days with inflation. And with interest rates being much higher than they've been in the last few years, we're seeing more and more of this go away. But I got a few tips to help you actually save on your interest rates and still get into this real estate market. Let's start with tip number one. This one will sound counterintuitive, but if you can afford to buy a house right now, even with the interest rates being in the mid sixes to the low sevens, do it. But do it with this caveat, the idea that maybe a year, 2 years from now, if interest rates come down, you can refinance. This is kind of the old real estate adage of date the rate, marry the house. Now, I will say this with a disclaimer. We're in uncertain times. The Fed is trying to battle inflation, so they have influence on whether or not interest rates come down. And a lot of that depends on a lot of variables that are out of your control. So there's no telling when the interest rates will come down or if they ever will again. So you just need to know moving into this particular strategy that there's a possibility that you will be paying a higher interest rate for longer. We don't know if it's going to come down. Okay. Option number two, consider an adjustable rate loan or ARM. And I will say, because I know there's going to be people listening to this right now, Dia's nuts. He must not know what he's talking about, did not get us in trouble in 2008. And the answer is yes and no. Adjustable rate mortgages or ARM loans were around back in 2008 when the crash happened, and there were a lot of people that were in those loans, and that led to a lot of the collapse. But it's a little more complicated and layered than that. Many of the folks that were buying homes back then should have never gotten a loan of any sort. They weren't really qualified to afford paying the mortgage. On top of that, they were using a much shorter term than many of the ARM products that are available today. They were doing things like 2-1, which means 2 years fixed, and then every year after that, it is subject to go up or down based on how the market is going. Now, in this current landscape, many of the ARM products are 5 years, 7 years, and in some cases 10 years as fixed rates, and they are much lower than your typical fixed rates, 30-year, 20-year mortgages. So it might be worth it to save a little bit of money on that. Number three, this is also an obvious one. Consider increasing the down payment. There are a number of ways to do this. Maybe you are able to increase your saving rate and stock some money away. Maybe you are able to borrow from a retirement fund, or you have family members that are willing to gift you part of the money for a down payment, or you reach out to an agent like me to take advantage of down payment assistance programs that are available to increase your down payment amount. But the point is, you come to the table with more money to make your total purchase and loan amount less. The point of doing that is that it will also mean the interest rate is less of a pressure on you financially. So think of it like this. You have one person who buys a house and the loan is $200,000, and another person that buys it and has a loan of $1 million. Which one do you think a high interest rate will affect more? The answer is the person with the higher loan amount, the $1 million. So the more money we can bring to the table to shrink that loan amount, the better it will be for your monthly payment, ultimately negating the interest rate. And then lastly, we can buy down the points or buy down the interest rate and the points on that. So what that specifically means is if you have a 6.5 interest rate right now through many of the offers, if you're able to bring an extra 10,000, 20,000 or more in some cases, ask the lender, and you can buy down part of those basis points, you can drop that down below 6 to the high 5s, maybe even a little bit less than that. And that, of course, will affect your monthly payment and your overall interest rate. Plus, what's also really cool about this current market, buyers have a little bit more leverage to negotiate with sellers now. So sellers will often pay that money at closing if you are a good looking buyer in terms of the overall offer you have on the house. So they'll come out of pocket and credit you $10,000 or $20,000 so that you can buy down your interest rate. The point is, you have a lot of options. Don't be afraid of what's going on in the market and where the interest rates are. Talk to an agent like me, and we'll come up with a plan for you so that you can actually get that interest rate lower and help you get into the house. Hit me up if you have any questions.